Londra'dan herkese merhaba. Londra-İstanbul hattında piyasalara özel bir parantez açıyoruz. Bu bölümde çok değerli bir konuğum var. Wietoska ile birlikteyiz. Kendisi Deutsche Bank'ın Doğu Avrupa, Orta Doğu, Afrika ve Latin Amerika Araştırma Direktörü. Christian, thanks for joining our program.
Thank you very much for having me.
First of all, congratulations on the new regional edition. You'll now be closely following Latin America as well on top of your existing regions. This will allow you to draw a broader global picture. So let's start with the big picture. As we enter the final stretch of 2025, what's your reading of the global macro landscape?
Yeah, thank you very much. Yeah, indeed. I think if we look at global markets, they're on fire right now in terms of risk sentiment. So equities in the US climbing from highs to highs. In Europe, equities have been well supported. Obviously, a lot of excitement still on AI, on the tech sector. Some call it to a certain extent a bubble developing. I'm not an expert on equity, so I don't want to comment on that or make any forecast. But there's definitely signs that kind of valuation is not purely driven by idiosyncratic stories and intrinsic value, but more driven by technicals and global sentiment and flows. But there's definitely right now, it's very difficult to stop it as also the news on the global front remain quite constructive. Obviously, we had the announcement over, this week with the China and US agreement. So from what we know so far on agreement on tariffs. And so that the market, in my view, should see this as also another boost or some uncertainties as taken out of the market. This should be very supportive again for emerging markets, for Europe as well in this context. So the external backdrop, all these, while there is still uncertainty, I think these kind of developments continue to push risk stronger, and I think this should be quite positive into year end. Obviously, the Fed and the ECB matter as well. The Fed has cut rates this week, but it was very interesting that there was a very very hawkish press conference. So the expectations of the market of a done deal of a December cut has been taken out to a certain extent by this, and they have definitely, the bar is a bit higher for a rate cut than initially expected. We saw a large move in US treasuries, in particular on the short end of the curve, but it hasn't changed our view that we still believe as a house that the Fed cut in December is our base case scenario. Now with a slightly not as convincing anymore from our US economists than we expected it before the meeting. But still, this should not derail, in our view yet, kind of the positive sentiment that we're seeing into year end with favorable technicals and still kind of overall very positive risk sentiment with improving potentially growth dynamics in Europe as well into next year.
So, Christian, when you look at the emerging regions that you cover, and it's a huge region right now, including Latin America as well. So, what is the big picture in the emerging markets, and what is the position of Turkey in this emerging league?
Yeah. So, I mean, the overall outlook, and we also I just come back from the IMF meetings where we spent a few days seeing clients. I think and speak with policymakers and decision makers. So the excitement remains for EM. So we had a lot of various years with outflows from the asset class, with poor performance, and a lot of structural issues. And I think there is still a trend that there is now a positive narrative building in EM. And but there are also two or three things to keep in mind here. On the one hand side, a lot of emphasis this year has been put on this relative performance. And I think EM and Europe has done better purely because the US dollar was weaker. And we have seen a bit of outflows from the US or rebalancing after this US exceptionalism, which has been driving global markets for a long time. So it's just on a relative basis, it kind of the region could catch up. So the question now that a lot of investors have in their mind is, can this now lead to an absolute outperformance? Can we now see more, not just a tactical or temporary kind of excitement and strong performance in asset classes in EM, but then can this lead to a longer period of strong performance and inflows? And here we need to, there's still uncertainty on that. So whether EM can beyond just US dollar weakness perform or not will be seen next year. And I think what's crucial for that are three things. One, we need to see stronger growth, domestic growth. We need to see that, of course, we don't want to have a global, tariff war again or any kind of uncertainty on that. So the more clarity we have on that is positive for EM. But secondly, also domestic growth dynamics need to continue to improve and need to see that they are outperforming the US to get off structural inflows into EM. And third point to make is we shouldn't forget that at the end of the day, it also matters that we see no policy mistakes from central banks or from governments on over-delivering on fiscal or central banks cutting rates too quickly, too soon to not build these buffers, which have been basically created over the last few years. If you look at real rates in EM, they're very high in historical standards. And this is because central banks have been cautious in the cycle to build this buffer against external challenges. And now they have room to potentially deliver a bit of rate cuts, but it has to be very cautious to how to act on that. And if we look at Turkey in particular, obviously the rebalancing, which has been very successful on the economy over the last few quarters, I think this is still intact. I think there's hardly any country that benefits more from the spike in gold and the decline in oil. So the gold-oil ratio has been extremely supportive for the country and also for the central bank as the FX reserves continue to grow because of that. So the macro vulnerabilities of Turkey have been reduced quite a bit. So they are definitely very positive signs when it comes to Turkey. The challenges remain, and the biggest challenge remains the stickiness of inflation. And I think this is a big problem, that domestic demand is still very strong. And at the same time, inflation expectations are not anchored. Household inflation, which just came out this week for October, they showed an increase to I think 54.4 or 5%. So that shows you like kind of what the mindset of retail, of local still is. And if you cannot anchor inflation expectation, you run into challenges at some point. This inflation inflation trap, I would say, mid-level around 20 to 30%, where it will be difficult to get it down that. So right now, the underlying inflation, the last inflation print in September was higher than expected. We also expect October to be quite high, 2.7%, in fact.
2.7.
2.7 months over months, exactly, which is out next Monday. I think there's a lot of uncertainty on this one, but it will be another one which should be a bit, not as favorable as the central bank would like to see it. If we are correct, I think it's going to bring down headline to 33.1% from 33.7, which is still disinflationary. Real rates are quite high. The central bank, which cut rates last time by 100 basis points, scaled back the easing cycle after over-delivering relative to market expectation in 2 meetings in a row. It still opens the door for another rate cut in December, definitely. So there is still on the cards at the moment. We are forecasting 100 basis points.
In December again.
In December as well. So that would then leave rates at 38.5%. But it's definitely important to have a slower pace of the easing cycle, considering that inflation proves to be higher than the central bank initially expected, the government expected, and that also market participant initially hoped for. So our year-end forecast just on inflation is slightly below 32%. So it's well above the upper end of expectations on the CBT, which is 29%. So it definitely means we are going to end the year very, very likely. I think this is now, more or less a done deal, above 30%, which makes it a bit tricky going into next year. So long story short, there are a lot of positive developments in Turkey on the econ side, on the rebalancing side, on the lower macro vulnerability front, benefiting a lot from the lower oil price, higher gold price, while at the same time the rebalancing, also the boost that the German fiscal spending spree we are hoping for next year has a positive impact on European growth. Very, very supportive for Turkey. But I think the biggest challenge remains still the stickiness on inflation. And it's just important that we are not seeing an overreaction of the central bank cutting rates too much, but focusing also on the medium-term inflation expectation, on the outlook for inflation beyond the next few months.
Christian, last question. Do you expect any TL volatility in the coming months, both because of internal issues and external issues? What's your year-end dollar TL expectation?
Yeah, that's a very, very good question. So, you should never say, there is no volatility in Turkey. As we know, we have seen vast shocks in the past. But at the moment, we as a house feel very comfortable with being long the lira. And we think even because of this stickiness and inflation that I just talked about, I think that's even more important for the central bank to keep a lid or keep a focus on having low FX volatility. So we are still expecting real appreciation into year end, despite less favorable flow dynamics or seasonalities. But we still think the central bank has enough firepower to withstand any external challenges or even domestic volatility. So we expect real appreciation. We expect the currency to go to 43% to 43 by the end of the year. So we are still recommending our clients to be long. At some point early next year or by Q2 next year, the ability to use real appreciation further to manage inflation, if inflation lower, will get to a level where it's not possible anymore. Other factors like fiscal needs to be also supportive, or structural shifts need to happen to support disinflation. But at the moment, the strategy remains, in our view, to use real appreciation to generate a lower inflation. And for that, we are constructive on the currency. Just one final word also on the bond market, because we get a lot of questions on this. Foreigners have seen the attractiveness, obviously, given the yield levels, and we have seen inflows again into the bond market. We still have a cautiously constructive bias, and then we are long the bonds in the 2 to 5 year part of the curve, and recommend our clients to be long. The challenges, in my view, is just for the longer dated bonds, simply because the question is how is inflation? Is it possible to get inflation below 20% in the long term? That is the key question for me. And if I can answer that credibly with yes, then the bonds are very, very cheap, and I would recommend someone to invest for the next 5 years. But I think these question marks remain, and makes it the most difficult, the biggest challenge for Turkey over the next few months.
Christian Wietoska, thanks for joining our program. Deutsche Bank'ın Doğu Avrupa, Orta Doğu, Afrika ve Latin Amerika Araştırma Direktörü Christian Wietoska ile buluştuk. Sözü İstanbul'a bırakalım.